National oil firm Petronas has returned to the black in its fourth quarter ended December last year thanks to cost-cutting efforts. But it's not sure if the worst is over. Net profit came in at 9.4 billion ringgit, a reversal from a net loss of 4.7 billion ringgit a year ago. This is because of lower net impairment on assets and a drop in net product and production costs. However, revenue dropped 2.5% to 58.6 billion ringgit from 60.1 billion due to lower oil prices and sales volumes. For the full year, earnings were up about 28% to just under 17 billion ringgit from 13.2 billion in FY15. Top line came in 17% lower at 204.9 billion ringgit, down from 247.7 billion the previous year. It will pay 13 billion ringgit in dividend to the government. Despite the improved numbers, its president and group CEO Wanzo warns that the worst may not be over just yet. This, amid concerns of booming US crude inventories as well as fears that OPEC may not extend its output cuts. However, he believes Petronas is also in a stronger position heading into 2017. Going forward, the oil giant will continue to focus on optimizing costs and productivity. Petronas Chemicals, or Petchem, admits that it's having a tough time finding investors for its Rapid project in Pengerang, Johor. Recall that Rapid got a boost last month when Saudi Aramco, the world's biggest oil exporter, said it will invest $7 billion. However, according to Bloomberg, it is still looking for petrochemical firms from Asia and Europe to invest in a $27 billion project after at least 3 previous deals got called off. Petchem chief Sazali Hamza told the agency, "It's tough to find investors because of the uncertainties of the oil situation. But if everyone's agendas can be aligned, he believes it will happen." He was cited as saying that companies from Japan, South Korea, China, Taiwan and Italy have expressed interest in Rapid, although he declined to name them. With the project gaining momentum, Petchem is reportedly planning to up capital spending by as much as 1/4 this year and next from 2016's 4 billion ringgit. This will help raise production capacity of basic chemicals from 10.8 million tons per year now to 16 million tons by 2020. DAP lawmaker Tony Pua says there is no way 1MDB will be able to submit its FY15 and FY16 accounts to the company's Commission Malaysia on time. Pua says this is because without an opening balance, it is impossible for 1MDB to complete the financial statements. And that's due to the fact that the previous accounts for FY13 and FY14 cannot be relied on. Given that the previous auditor, Deloitte, has disavowed those financial statements, Pua says it is clear that there have been no audited and certified accounts for the 2 fiscal years. Also, the new auditor, Parker Randall, has not decided whether to conduct another audit on the books, which means a financial audit for the year just won't materialize. Pua says the only resolution for the matter is to conduct another audit on the contentious accounts. Bermaz Auto, the distributor of Mazda vehicles in Malaysia and the Philippines, saw its third quarter net profit falling 39% as revenue shrank. This is also because of weaker results from associated firms and higher vehicle costs due to a weaker ringgit. Earnings stood at 25.1 million ringgit, down from last year's 41.1 million ringgit. Likewise, revenue also dropped, down 35.2% to 338.7 million ringgit from 522.6 million. That's because it sold fewer cars. Bermaz says this was thanks to softer consumer demand, made worse by intense competition, with local car sales driven by aggressive discounts and promotional activities offered by other automakers. Bermaz announced a third interim single-tier dividend of 2.75 cents for FY17. It expects the last quarter of FY17 to remain challenging with subdued sales amid the current economic condition and the weak ringgit. However, it hopes that new model launches in FY18 will help mitigate the impact of a soft domestic market. Domestic Trade, Cooperatives and Consumerism Minister Hamza Zainuddin says the impact of the recent sugar price hike on consumers is minimal. In fact, he believes Malaysians should be grateful that the increase was not more marked, considering the fact that all of the country's raw sugar is imported. According to Hamza, over half the sugar in Malaysia is brought in from Thailand, where the coarse white sugar retails for 3 ringgit and 20 cents per kilogram. In comparison, the retail price here is 2.95 after last week's hike of 11 cents or 3.8%. And since Malaysians consume about 2 kg of sugar per month, he says that's just a 22 cent impact from the price hike on a monthly basis. According to Hamza's calculations, the increase in global sugar prices, coupled with a weak ringgit, have resulted in almost 100% higher import prices. He points out that in 2013, prices averaged 15 US cents per pound when the exchange rate was 3.2 to the dollar. Today, prices are averaging 21 cents per pound, with the ringgit at about 4.4 to the dollar. The last time Putrajaya revised sugar prices was in 2013.